Will inflation push the Fed to pause? Welcome to Market Insights. I'm Ludovica Brignola. Fed's Chair Jerome Powell pushed the issue of rising prices into the spotlight this month, as he said that progress on inflation had been more bumpy than expected. US inflation data out on Wednesday will provide clues for investors on the likely timing and speed of interest rate cuts by the Federal Reserve next month. So what's happened to the inflation outlook in the US? And has the disinflation progress really stalled? Well, joining me now to talk about all that and more is Andy Schneider, Senior US Economist at BNP Paribas. Thank you very much for being with us today. Right, so speaking about US inflation outlook, where do we stand right now and how bumpy is inflation expected to be in the near future?
Well, thanks for having me. And I think you framed the question well, where I think the inflation outlook, we're seeing a lot of progress, and generally inflation is coming down, but it is bumpy. So in Q3, we had some really good prints, and it's been a little more firm lately. But I think the high-level view for us is that inflation is making progress and coming down, but we have a very different outlook going forward with the election, where if we didn't this incoming administration, I think, can affect policies that could change the inflation outlook compared to what we've seen this year.
Right. In your notes, you say that the new administration policy proposals tilt the inflation outlook risks to the upside. Can you walk us through exactly what policies are expected to trigger higher inflation and how? What's the process there?
That's right. So I think when we think of the new administration's policies, three main ones come to mind: fiscal policy, immigration policy, and then trade policy, i.e. tariffs. And walking through each of those, fiscal policy likely to lean more expansionary, so that should be both growth positive, but also inflation positive as well. Immigration policy, this big waves of immigration that we saw in the last few years, a key effect from that was increasing the labor supply, which moderated wage growth and really helped ease those supply-demand imbalances in the labor market. So if we have a reversal in that policy, even though that should be a bit growth negative, that should be inflation positive. And then I think the big one is tariffs. We've heard Trump propose tariffs on a larger scale than the first round of his presidency. And we think that we have to take Trump seriously and literally. So I think tariffs at that scale could have not only large first-order inflation effects, but large second-order ones as well.
Right, very interesting. And speaking about one particular aspect of inflation, shelter inflation seems to remain sticky. Not so much rents of primary residences, as you say, but the owner's equivalent rents. Why is that? And do you think that's a source of concern?
Yeah, so I feel pretty optimistic on the shelter front when you look at some key kind of supply side indicators, building construction, the ratio of the housing stock to the population, and importantly, the vacancy rate. All of those are telling a story that shelter inflation should likely keep moderating. But as you noted, OER has been a little firmer than rent to primary residence. I think some of the recent prints we've seen of noise, we did see the sample change to weight single family housing a bit more early in the year. But I think going forward, what's interesting is when you do look at U.S. housing supply, it has been a little more concentrated towards apartment buildings, multifamily housing, where single family has been a little bit more lagging. So prospectively, that divergence could make for OER coming in a little bit firmer than rent to primary residence as we go forward.
Right, and finally, tomorrow all eyes will be on the PCE and core PCE, right? I mean, the Fed's preferred measure of inflation. You say, interestingly, in your report, that despite the fact that PPI came in slightly warmer than expected, that this is expected to only have a limited impact on longer-term inflation. Why, and what do you expect for PCE?
Yeah, so we're looking at 28 basis points on month-on-month core PCE. So that would be the second straight rounded 0.3 print, which is a bit firmer than the 0.2s that we got in the prior 3 months. But when we look at the details here, we think it's an instance that the details are a bit better than the headline. Specifically, we got a big increase in portfolio management fees and PPI, and used cars were really a big increase in used cars as well. So those are kind of transitory, idiosyncratic factors, and we don't think there's a lot of signal there in terms of inflation going forward. And we think the Fed is probably going to have a similar reaction to that. So when we're looking at December, the Fed's going to be data reactive. We get another CPI report, we get another payrolls report before December. But I think just this core PCE report on Friday alone is probably not enough to push them into a skip for December.
Fascinating insights. Andy Schneider from BNP Paribas. Thank you very much for being with us today. And that's your Market Insight. Don't forget you can watch more videos on Reuters.com.